Welcome to the Snowbirds Expat Radio Podcast. I'm Gerry Scott, founder of the Snowbirds US Day Tracker and the Canada Physical Presence Tracker app.
Good morning, good afternoon, good evening, no matter, depending on where you are in this lovely country or if you're in the United States. Today we have Stephen Flynn from Andersen. He is a partner of Andersen, and at the end of the podcast, we'll share the information on how you can get a hold of this wise man. This wise young man. And Steve was one of our first guests on our podcast about being reminded about 16 episodes ago. But today we're going to be covering all these, the vacancy taxes and all these taxes that foreign buyers have to deal with in Canada. So Steve, are you ready? I'll ask him slowly and we'll let you take over. But are you ready to go?
Absolutely ready, Gerry. Happy to do this morning or this afternoon and wherever people are listening. And there's a lot of material in here. Looking forward to getting into it with you.
And before we get into it, Steve and I had a chance to get together a couple of weeks ago, and I didn't do a very good job representing Vancouver Golf Club in our little golf match. But hopefully I left without paying. Hopefully I didn't leave without paying any bets that I owed you guys. So
we were on the same team, Gerry, and I can confirm that we didn't miss the cut, and we will be able to play next year.
Oh, that's wonderful. Well, that's great. Well, tell you what, let's get into it. So here's the first question we have is, and there's going to be 10 questions. There is a new Canadian Federal Vacancy Tax for 2023. Tell us more about it.
Sure, absolutely. The federal unused housing tax came into effect, really started to come into effect this year. It applies to owners of Canadian residential houses during the 2022 tax year. And so this really already took effect last year. 2023 is the first year that individuals may have to file forms and may have to pay this tax. It's a 1% tax on the assessed value of the ownership of certain residential properties in Canada. It's in general a tax that's to apply to foreign nationals, and that's generally defined as people who aren't Canadian citizens who are not Canadian permanent residents. But the tax can also apply to Canadian corporations, partnerships, and trusts, and other types of entities.
Okay, when you say is this going to be part of the assessments that they have every year that property taxes are due? Is this going to be on top of those taxes?
Well, that's right. This is in addition to any income tax that we have for the use or rental of property. It's in addition to any provincial property tax or local city tax or county tax or any kind of assessment. This is a new assessment from the federal government on the ownership of homes. It was designed to combat the high housing prices and low supply of homes in Canada. And it is just yet another level of taxation on the underused or vacation or low usage of residential real estate in Canada.
Well, you kind of think that maybe high interest rates have kind of taken care of the pricing cost of housing in Canada. So how does this new tax apply to U.S.-based owners of Canadian property?
Sure. So we see that quite a bit with U.S. owners. And so you'll have a lot of situations where people based in the United States will own a vacation home across the border in Canada. They'll have a cottage. They'll have a home in a major center. And, to the extent that those individuals are not Canadian citizens, and if they're not Canadian permanent residents, they could be subject to this 1% tax, unless they take a couple of steps to try and avoid or minimize the amount of that tax. And so this isn't something that's, that the U.S. owners have seen before on a federal level, and they're starting to see that starting this year. And unlike some of the other regional taxes we'll talk about later, this is in general a tax on real estate all over Canada. And there are a number of exceptions. We can talk about that.
And I do apologize if I cough a few times into the mic. We went on a cruise last week, so I'm sure that it's not hard to pick up a cough or a cold or whatever else on a cruise ship these days. So here's the next question we have is that, are there ways for U.S. owners to avoid this tax?
Well, there are. I mean, one of the biggest ways to do it is just to rent out the property. And so to the extent that a U.S. owner has a tenant in the property, if they've got it rented out for 6 months or more in the year, then they wouldn't be subject to this tax. And this rental activity is defined quite a bit differently from some of the other taxes. There isn't a need to have this home be a permanent or a principal residence for someone. So you don't have to have one tenant in there for 6 months or more and have them treated as their permanent home or their principal residence. You just have to have a series of rentals that are 1 month or more in the year, that total 6 months for the whole calendar year. So if you've rented it out, then you can have an exemption. And the other way to exempt it is that if these properties are in rural areas, and there's a definition of that, that in general, I think if the population of the center is less than 30 or 35,000 people, then if you're in one of those designated areas, so long as you use the home yourself for 28 days or more in the year, so as long as you're using it and it's in one of these rural areas, you wouldn't be subject to this tax. So those are kind of two of the common ways to avoid that 1% tax.
And how does a U.S. owner find out if that house is considered to be, I want to say designated, is it a rural area? Is it come down to the mailing address? Is it RR?
Well, it does. It's focused based on the postal code and based on the address. Canada Revenue has made a tool available on its website that if you punch in the address, it'll confirm if it meets the definition or not. And I think it's something that this can evolve over time. And so there are all sorts of population centers in Canada that are close to that line that may meet the test or may meet the availability in 2002, but if it grows in population, it may not meet the test in a future year. So it's always good to be checking this every year.
Now, and I'll get into this a little bit more down the line here, but how does Revenue Canada, how are they able to enforce this to these people?
Well, and this is a new tax, so it's going to be, it's remains to be seen how Canada Revenue is going to enforce the tax on their end. What they've put in place are some fairly significant penalties for failure to comply with this. And so, one of them is individuals, entities that are subject to this are required to file a form, and it's a brand new form. It's about 8 or 9 pages, and it lists all the different things about the property, its assessed value, how do you use it, are you exempt? And so you got to represent this to Canada Revenue every year. The deadline is typically April 30th of the year. In this first year in 2023 that affects the 2022 year, Canada Revenue gave some grace and said, as long as you file this 2022 year form on or before October 31st, 2023, then they wouldn't be subject to any penalties. If one misses that deadline, one way Canada Revenue can enforce this would be, well, we'll assess a penalty, and Canada Revenue's penalties are anywhere from $5,000 to $10,000 for failure to miss the filing deadline, depending on who the owner is. But even worse is there are a number of entities and a number of organizations, whether it's a trust, a partnership, or a corporation, that may be exempt from having to pay this tax because either they've got a Canadian citizen owner or partner or trustee, or they rent the property out, but they'd still have to file this form. And again, failure to miss that form could subject it to a penalty, even though they don't have to pay the tax. Worse yet, if you go long enough and don't file the form, Canada Revenue will deny the actual exemption you might be claiming. So even though you might not be subject to the tax because you've rented it out or because you're a Canadian citizen, if you don't file the form, Canada Revenue will deny the exemption if you don't file it on a timely basis. And therefore, you could be subject to that 1% tax for the year, even though you shouldn't be. So that's one stick on how Canada Revenue can do it. And I think it remains to be seen down the road how they'll try and make enforcement for non-filers. It's always hard to find those that don't file, but there's a lot of information available to tax auditors through all sorts of disclosure methods and all sorts of requirements to find out who owns these properties.
Without mentioning what neighborhood I live in, and I don't think I've ever given anybody my address on our show here, but there are people in our neighborhood that have these big, beautiful houses that are not being looked after, and they are vacant. I mean, do you ever see them coming by and actually starting to talk to residents of the area and asking if anybody has come and gone from this house? Have you heard of anything like this at all?
Well, I'm not aware of it, but certainly as an audit technique, that would be something I would think an auditor would be looking at. I mean, I'm aware of stories that won't affect the federal one because it's so new, but we've had local ones, including the city of Vancouver, which for 5 or 7 years now has had the empty homes tax. And it's a tax that's a similar one. Those city auditors can do everything from kind of looking at utility bills to looking at ownership to actually just physically inspecting downtown condos, if you will, in say Victoria or Vancouver or Kelowna Vancouver, pardon me, because it's a Vancouver tax, and look at the Vancouver condo and say, okay, at night, if we don't see any lights on, or if this particular building has very few lights on, then for a period of time, it must mean that there's a lot of absent owners, and that might be an audit target, is to actually target blocks in a particular street. And just, again, then you kind of go through that process of, okay, we'll prove that you did have someone in that property.
Now, got so many thoughts going through my head, and I'll save the kind of the other questions towards the end. But I understand that the Canadian federal UHT filing requirements were extended from the normal April 30th date to October of 2022 at the end of October. What happened? And once again, I think you already have answered this, but what happens if they miss that deadline?
Well, that's the twofold thing. I mean, one could be the penalty by even missing it by a day of kind of $5,000 to $10,000, depending on whether you're an individual or if you're an entity. But the other one is if you miss it again by kind of there's another secondary deadline, and I believe it's a few months later. If you miss it for the whole time, you can completely miss the exemption, and so Canada Revenue isn't obligated to actually grant you the exemption. And so even though you might be exempt because you're a Canadian citizen, shareholder of a Canadian corporation that owns a property, or maybe you rent it out through a partnership, if you don't file the form, Canada Revenue can deny you the exemption, and now that that $2 million property has a 1% or a $20,000 tax assessed to it. I was recently at the British Columbia Tax Conference where one of the presenters talked a bit about amnesty programs, and that there is no formal amnesty program that Canada Revenue has for this form. However, in other circumstances where there's either income tax filings that haven't been filed on time, or carbon tax, Canada Revenue has had some mechanisms for amnesty programs to file delinquent. It remains to be seen what Canada Revenue will do, in the underused housing tax requirement.
Now, is this a simple form that individuals can file, or do you find that you guys are getting a lot of volume on this type of filing?
Well, as you can imagine, Canada Revenue doesn't make anything simple. When you look at this form, I think it's either 8 or 9 pages, and there's a whole host of questions that I think are difficult for the layperson to answer. I think a lot of people can try and do this themselves, and I think that's, hopefully what many people could do. But others, when they look at, okay, does the exemption apply, or how does the rule apply, or, even who is the owner of the property and who is supposed to file, it's not always that clear. For example, we'll see situations where it might be a trust in Canada that owns a property, and you would think, okay, well, if the trust owns the property, well, then, it should be the trust that files the form. And in fact, it's not the trust, it's the individual beneficiaries that should be filing the form. And so it's those kinds of nuances that I think make it, somewhat difficult to comply with this fully and completely.
Now, have you followed up with any of the realtors out there? If people are just saying, hey, it's not worth it, if it's a 1% based on the value of the property, the assessed value of the property.
That's correct. Yeah.
Are you finding that people are just selling these properties?
Well, I think we've seen that before, more from the provincial and city regulations here in British Columbia, where, when we've got U.S. owners that have the property and they want to use it personally, and it's maybe awkward to rent out, or they're trying to have, family members use it or themselves use it, but they just can't meet the requirements. And some of them are quite stringent, that when they look at, and we could talk a bit about, British Columbia and Vancouver, if you look at just a condo in Vancouver that, if you're not using it enough and you have to pay those taxes, the British Columbia tax for a U.S. owner would be 2%. The Vancouver City Empty Homes could be 3%. So add 5% plus this federal one of 1%, add 6% onto the assessed value of, say, a $5 million condo, and you're paying $300,000 a year in vacancy taxes. That becomes untenable. This becomes, too much to bear for that cost. And so we are seeing people saying, I'll just sell and stay in hotels, or I'll just sell and rent if I can, because that's just too expensive. So we are seeing it.
So yeah, you start adding up 6% on a $5 million place, and that's $300,000. Last time I checked, hotels were a little cheaper.
Well, that's just it. I think people look and say, that's a tipping point, and that one can argue if is that what the legislators wanted. Perhaps it is, but that's the effect this is having. I don't know that it's widespread, but you're starting to see it certainly on higher end homes.
Now, when this was all coming, like we know that it was applied in 2022, how long do you think it took them to really figure out this bill federally? How long were the discussions? I mean, is this something that went on for 5 or 6 years and finally they pulled the trigger?
I don't know the exact time. I mean, it was the Liberal government probably proposed it before 2022. So I think there was an indication that, this was coming. And certainly, I think our federal government looked at, some of the implementation in British Columbia that happened with first the City of Vancouver empty homes tax in 2017 or 2016, and then the provincial one in kind of 2017 or 2018, 2019. When they saw that being implemented, I think they can take, some from that to say, okay, well, this is something that we're considering as well, and it's been in the works for a little while. I'm not sure how long, but certainly a few years.
Okay, so the Canadian Federal Vacancy Tax is very different from the British Columbia speculation and vacancy tax. What is the big difference between the two?
Well, I think it's how they
provincially.
Absolutely, I think it's how they apply. I mean, you can have situations where someone is a Canadian citizen or Canadian permanent resident. Maybe they don't live in Canada anymore, but they own a home, and they would be exempt from the federal 1% levy so long as they file the form. However, the British Columbia speculation and vacancy tax is more focused on, are the homeowners paying their, what in their words, their share of income tax to the federal and provincial governments. And if they're not paying their share of income tax, they may be subject to the BC speculation vacancy tax, even though they're Canadian citizens and even though they're Canadian permanent residents. So, for people who aren't residents of Canada that have homes in the certain areas in British Columbia, they could be faced with that 2% tax every year, even though they may be exempt from the federal levy and they may be exempt from the Vancouver levy.
I think back, and I'll use this as a scenario. We had a home up at Sun Peaks for years. We used it ourselves, and I bet we were only there for about 40 days a year, probably a couple of weeks at Christmas time and a couple of weeks during the summer. So I guess if we still own that place now, how would that play out for us? Would we be paying a vacancy tax on that place up at Sun Peaks?
Well, I think the first thing you have to look at is what is the region in British Columbia that are affected by this? And it's kind of 5 or 6 different regions. And so, it starts with the Lower Mainland. It starts with the Capital Region or Victoria. It starts with the Okanagan and the north part of Vancouver Island. And over time, the BC government has added more and more regions. If you look at kind of what's happening now, places like Lions Bay and Squamish and Duncan are being added to the list of regions that are subject to this tax. And even other regions in British Columbia, Salt Spring Island comes to mind, for example. Although it's not included in the region of being subject to this tax, some of the residents there have petitioned the government and said, we'd actually like it to be included. And you'd think, well, why would you want to be taxed more? Well, it's because a lot of the residents of Salt Spring Island are concerned that the supply of homes is dwindling, and they can't get people to move and live there and work, and they need people to kind of stay and work and actually, be part of the economy. And so they actually think this might have an impact on them. So it's a growing kind of trend to see there's more and more regions being added. I don't know if I don't think Sun Peaks is part of one of those regions, but I know when I talk to a lot of my clients, when they look at that second property and they look at places like Whistler, which is exempt, they look at places like Vernon, which is exempt, but it's close to the borders that are. And I think that's just one of the things you have to ask yourself is it might be exempt now, but will it be exempt later? And if it's not exempt later, then you got to look at saying, okay, well, how do we avoid this? Do we then rent it out? And the BC speculation tax, you need to be a little more diligent in renting it out. It's got to be 6 months or more. It's got to be the same tenant. That tenant's got to be, it's got to be their principal residence. And so, you have to take that activity or, find some of the other exemptions or, acknowledge you might be subject to tax. The rate of tax for, say, someone like you, Gerry, if you were living in Canada would be less. It's 0.5% versus 2%, which is the tax rate for non-residents of Canada. It's still, it's still part of the cost you got to consider.
So even if a person said, I'm going to use Airbnb, once again, it's got to be 6 months rentals.
It's got to be a 6-month rental, and it has to be the tenant it has to be their primary residence. It can't be a hotel type or an Airbnb or a series of 2-3 month rentals. It's a different rental test than it is for the federal tax.
So some of these individuals that own these properties in corporations, and they're renting them out, and it's an actual viable business, so that they would not have to pay any vacancy tax.
Well, in general, that's right. I mean, it's again, you got to look at the rental test to say as long as it's a residential rental, if you will, as opposed to a weekly or a monthly rental. As long as it's a residential rental, that should meet the test.
Now, I think we've kind of answered this already, but for U.S. homeowners of properties in certain BC areas, how is this tax applied?
Well, yeah. So to the extent that your home that you own is in that region, in that area, it unless you've got it rented out or unless it's your primary residence. And what the BC government said is, 99% of homes are exempt because either they're rented or it's your primary or it's your principal residence. And so, as long as you're filing the form every year and making the declaration, you should be fine. It's that 1% of, again, let's say it's U.S. owners who have a second place here. And the way it works for U.S. owners is there's a concept called a satellite family or specifically an untaxed worldwide earner. It's a very technical term that basically says if you as a family, if less than half your income is exempt or not subject to tax in Canada, and your income is your family income, so it's yours and your spouse's income together. So if less than half that is taxed in Canada, in British Columbia, or in Canada, then it doesn't matter how you use the property, you're subject to this tax. And so you may say, well, no, it's being used. I mean, my kids are using it, they're going to university, or my parents are using it, but we own it. And that doesn't matter. Unless more than half your income's taxed in Canada, you're subject to the tax, and the tax rate's 2%. And so, that's a real challenge for families. Now, there are certain exceptions you can try to meet to get the rental exemption when you have your family staying there, but those can be very difficult to meet in those circumstances.
I think back to the pandemic and all these people that own foreign ownership, may it be our friends and your friends, have places in Scottsdale and Palm Springs and Maui and all these things. And there was this thought that after the pandemic, hey, listen, maybe we have something locally. Maybe we have something in Kelowna or whatever, but they've kind of taken that away from us, haven't they?
Well, whether it's taken away or there's a cost to that. And so if you're going to have that arrangement, and if you're not going to rent it out, and if you're just going to use it as your secondary home, there's a cost to that. And you just have to factor that in as almost like an additional property tax if that's where you're going to use that property.
Well, I guess I won't be leaving Maui anytime soon. So I guess the other question, and I apologize, we kind of jump around and we kind of answer two of these questions at the same time, but for U.S. owners of property taxes, for U.S. owners of properties in certain BC areas, how is this tax applied?
Well, when we talk a bit about certain BC areas, I mean, it's really important to understand that there's multiple layers in British Columbia. That there's a provincial tax, and this is the tax we talked a bit about it being a tax on the homeowners if they're U.S. people, and if they're not renting it out or if they don't use it as their own residence, then it's a 2% levy. But if the home's in the city of Vancouver, that's a whole different regime, and it's over and above the BC one, and so this is another 3% that can be on top of that. And so, each one of these jurisdictions has different rules, different filing requirements, different rates, and you just got to, be conscious, be prepared to look at where the property is and what might apply. So,
and I guess just touching base again on the speculation tax. So before, you were always hearing people were buying these pre-builds. So is that pre-build market kind of dried up now? Is it making that much more difficult?
Well, I mean, there's a whole bunch of other factors, I think, that go into whether the pre-build, what the economy is on that, or what the prospects on that are. So you talked about interest rates, and it could be demand, a lot of things. But from a tax perspective, when I speak with clients and prospects and talk a bit about, okay, well, here's what it's going to mean. One of the things we talk about is, what is your use of the property? If it's an investment property and you're going to rent it out, then we should be exempt from all these taxes. Yeah, we got to file some forms and things, but we should be exempt. But if you've got kind of a partial mixed use of, well, I'm going to rent it out, but I'm going to use it personally, now we got to look at all the different levels and say, well, how is this going to apply to you? And that can dictate or drive that they may make different decisions, whether they, decide to kind of hold on through the closing phase, or whether they say, well, maybe I better flip this thing because it doesn't fit how I want to use it.
I think of all these people that have actually bought these rental properties, not rental properties, but these second properties in these resort areas. And they've always kind of bought them on without putting a lot of thought into it, just emotionally saying, I love it here, let's buy a place. Well, it seems like, and even we see that a lot in Maui, in different parts of the desert, Scottsdale and Palm Springs. People buy these places and then they kind of figure, okay, well, how are we going to hold it? How are we going to use it? And of course, now in Canada here, they've already put the offer in. I mean, are you dealing with a lot of that where people all of a sudden have made these decisions and now you're kind of having to back them through it? Or what is the process?
Well, I think when you kind of look at the structure holding it, I think it's important to understand, not only who the owner is, what the uses is, but the important to understand is how are they going to own it? Because again, from the U.S. owner, when you go back and talk about the federal tax, for example, when they come and buy the property here in Canada and it's a vacation place, and let's say it qualifies in one of those rural areas and it would be exempt, and they say, you know what, I am going to use it 28 days or more a year. I'll spend a couple of weeks in the summer. I'll spend a couple of weeks in the winter. Yeah, I'll make sure I get there. Well, that's fine. But the other requirement then is, well, you have to own it personally in order to qualify for this exemption, this 28-day exemption. Because if you don't own it personally, then even though it's in a rural area and even though it might meet the 28 days that you use it, if you own it in a U.S. corporation or a U.S. trust, it's not going to qualify for the exemption. And so now you've got to find other ways to qualify for it. And it's a conflict because we can tell people, okay, well, from a Canadian perspective, this is how we think you should own it. But then as U.S. advisors, and we think about the U.S. estate planning and U.S. liability protection type, planning, we don't want them to own it personally. We want them to own it in another entity. And so the two conflict with each other. And that's where you have to kind of sit down and wrestle and say, well, what's important to you? Is it the estate planning protection or the liability protection? And therefore we use an entity and we're going to sacrifice and maybe pay this 1%. Or is the 1% so much that we can't afford to pay that? And you got to own it personally. We got to find other ways to protect you either from liability or estate planning. So, that's the merit and that's the importance of getting fulsome and complete advice on both sides of the border anytime a U.S. Client is trying to buy a Canadian property.
I think I've read this a few times in the papers where realtors are being held liable for not knowing the rules. So my question is, how many realtors have actually called you and asked you for your opinions, or even asked you to do a presentation for these realtors that are working in different areas of British Columbia or Canada that did have those foreign buyers coming in? Have you received many calls?
I have. I've had lots of realtors over the years talk to me, and I think they've been pretty smart over the years saying, well, we know there's issues here. We're not going to advise on this, but we need you to connect to our prospective client or buyer, tell them what's happening here. And I think those introductions are great to hear. And I'm always happy to speak with those involved in these types of situations. And we're happy to help. I mean, I think, using your example as a realtor, that'd be a tough thing to advise on. But I think the recognition of the issue, the fact that we've got this non-Canadian buyer, and there's a lot of tax issues we've talked about here, but there's a big issue right now in that in a lot of circumstances, non-Canadian buyers aren't even allowed to buy residential properties for 2023 and 2024. So this, now may become a non-starter, but, we have lots of families that come to us and say, well, a married couple would say, well, I'm not a Canadian citizen, but my spouse is. So then the spouse can still buy the property, but then you have to walk through all this. So, I think realtors are really been good at with us to say, okay, we recognize there's issues. Please talk to our client, and we're always happy to help.
So is it the lawyer who's doing the closing? Is it his responsibility to go over all these issues around the foreign, the vacancy tax, the speculation tax? Is it the lawyer's responsibility to share that with the for the buyer?
Well, that's a hard one to answer as to whose responsibility it is. Ultimately, it's the taxpayers, it's the clients, it's the buyer's responsibility to make sure they're informed. And, that's a hard one. Again, if someone's asking me for legal advice, I won't provide it because I'm not a lawyer. If someone's asking me for real estate advice, I'm happy to give 2 cents, but I'd say, you know what, a realtor knows this stuff way better than I do. If you want income tax advice, you need to get the right professional firm to help you. And to me, ultimately, it's up to the buyer to get that advice and to be well informed to make the best decisions for them and their family.
Okay, so now we'll move on to this foreign buyers. No foreign buyers for 2 years, is that correct? 2023, 2024?
That's correct. And a foreign buyer, I think, is generally defined as a foreign national. So if you're a Canadian citizen, you should be exempt. You should be okay to buy. If you're a Canadian permanent resident, I believe you're okay. There's some other areas when you come into a province, if you've got a certain immigration status or if you're in a certain field, you may be exempt from this. But in general terms, that's right. Unless you meet one of those criteria, you're not allowed to purchase residential real estate. And there could be fines for you doing so, and there could be big fines for lawyers, accountants, and other advisors and realtors for helping people to do that. So
it doesn't matter. As a foreign buyer anywhere in Canada, there is no exemptions. You cannot buy property in Canada.
So I don't want to get too specific here. In general, it's residential real property. And the specifics on where that is, we could get into later. In general terms, when you get in kind of the major population centers, that's what they're trying to ensure people aren't buying. So,
okay, before we close everything out, do you find this has actually worked in the favor of slowing things down? If the intention was to kind of get housing under control in Canada and provincially with all these vacancy taxes and speculation taxes. Have you had any feedback that this is actually working?
Yeah, it's a difficult one. I mean, I think when you look at kind of the local level here, and you've seen millions of dollars go into the city of Vancouver, the province of British Columbia for the taxes for the taxes that they're collecting. They've got some funds. How they use those, it's been early to see whether they've actually used those to try and create more inventory. Overall, I think our problem in Canada is a supply problem. It's we need to build more houses in major centers, in minor centers, in all sorts of different areas to keep up with the demand we have in Canada. I don't know that this is helping to increase that supply. I think it's had pockets of success in terms of higher end, homes perhaps being sold or turned over, but this isn't a solution to create more supply. The supply has to be from local governments, federal governments, and it's got to be from us as a society to say we got to create more housing to keep up with the demand.
I look outside my window right now in beautiful cloudy Coquitlam here. I've got 2 towers in front of me, which I could try and hit with a driver, and then I've got another 6, 7 in Lougheed Mall that are just So the housing in Coquitlam is just unbelievable. How many holes in the ground that are building these towers and stuff.
Yeah.
Yeah, so I think we're doing our part. I don't know about your hometown of Richmond. You guys seeing a lot of building going on?
Well, certainly in Richmond, when you look at the corridor between the west side of Vancouver, St. Number 2 Road, and to City Center, kind of around the Olympic Oval and in that area, it's an incredible amount of development that's happened over 10 or 15 years, and it will continue to do so. And so there's a lot more doors being added there. Places like Richmond Center and Lansdowne Mall are over in the next 8 or 10 years being again converted into more doors. I can't remember the numbers in the city of Richmond, but it's potentially 40,000 people more that will move into the city in the next 20 years. And, the city has to have it, planned to accommodate that. And you can see it in that area, certainly. And so.
Now, outside of your practice or within your practice, I mean, obviously, the speculation tax and the foreign buyers tax and vacancy taxes, et cetera. What else are you finding that you're keeping you guys pretty busy with Andersen? on the U.S. tax side?
Well, certainly from my area of practice, which is private client services, I see a lot of families that are changing locations. They're moving from Canada and they're moving to the United States. They're leaving the United States. They're coming to Canada. So there's a lot of transition over the last 3-5 years, and I think that continues to do so. And that could be anything from business leaders saying, I want to start a business or continue my business elsewhere. It's people who are retired who are saying, I actually want to leave where I work and come back to either my home or where my grandchildren are, my children are. We see a lot of that, and they come with citizenship they didn't have before. They come with assets they didn't have before. They come with reporting requirements on both sides of the border. And, for Andersen, that's a really unique space for us because our group here, we have the ability to help on both the Canadian and U.S. tax side. And so we see that, from a private services. I think from a business perspective, we're seeing a lot of businesses now as the pandemic's lifted and things are starting to move. We see businesses expanding to the U.S. We see U.S. companies coming to Canada. And so we're able to help from a business perspective, whether it's the structure, whether it's how do you organize yourselves or how do you file U.S. and Canadian corporate tax returns and how do you manage all this together. And we're finding more activity in that area.
That's interesting. So, Steve, I really appreciate your time. So how do people get a hold of you?
Well, happy to help, Gerry, and appreciate that. So I'm based in Vancouver. I'm part of a group here. We're about 48 people between Vancouver and Calgary, and we're always happy to help if you've got cross-border Canadian U.S. tax questions. Best way to reach me is just through an email, and my email is stephen.flynn@ca.andersen, and you can see Andersen spelled behind me, .com. So again, stephen.flynn@ca.andersen.com. We've got a website as well. If you Google and search my name and Andersen, you can also get my email address that way. I'm happy to hear from people, and if we can help, great. We're always happy to do that. So.
Well, I truly appreciate your time, and I know it's getting a little colder here, so I guess we won't see you on the golf course until another 3 or 4 months. So thank you very much for your time.
Maybe next year. Yep. Thank you, Gerry. Appreciate it. Always happy to help.
Okay, wonderful. Okay, stay safe.
You too. Talk to you later.
Thank you for listening to the Snowbirds Expat Radio Podcast. Our app is available for your iPhone and your Android. If you have any questions, call me 604-612-7526. Until our next podcast, I'm Gerry Scott.